Like other commodities with wholesale markets, the electricity wholesale market is where electricity is frequently bought and then resold before it ever reaches the end customer. Wholesale participants in this market may not always own resources that generate power, and they may not always directly serve the end users. Three major types of participants engaging in the resale markets include electricity utility companies, independent power producers, and electricity marketers. In addition to directly buying or selling in the spot market, companies can also engage in transactions through bilateral negotiation, using a brokerage platform, or through a futures exchange. The transaction could be either a standardized contract like futures, or they could be customized like complex contracts known as structured transactions. In between the wholesale market and the end customer are the load-serving entities, or LSE. An LSE can either procure electricity in the wholesale market, or they may own their own electricity generation resources. In the physical market, system operators determine the locational marginal price through an auction process. Various plants place electricity offers at different prices. Based on the predicted load, an ISO selects the plants that meets the load requirement and pays the highest price selected to all selected generators. The locational marginal price is based on the marginal unit offered by each generator. In this example, considering load requirement of 3,000 megawatt for the next hour, wind, solar, nuclear, and gas plants are selected and dispatched based on the offer price of the highest priced generator. In this case, the gas combined cycle offer price of $40 per megawatt hour. Let's look at an example of a nuclear plant that currently sells electricity in the PJM regional spot market. Assume it's March and the nuclear plant economist has a positive short-term outlook for PJM regional electricity spot price during peak hours for the month of May, and the nuclear plant operation costs are $20 per megawatt hour. How could the economist take advantage of the potential for a short-term price increase and also protect their downside price risk to ensure they have enough funds to maintain continuous operations? One option would be to negotiate a customized short-term deal with other wholesale marketers, but this can be costly and time-consuming. Another option would be to execute an option strategy on an exchange-traded futures contract. This type of strategy allows the plant to take advantage of a standardized product at a lower cost that can offer more flexibility to meet their needs. Let's assume the May average forward price for PJM Western Hub is around $35 per megawatt hour. Given its 1,000 megawatt per hour capacity and 80% utilization rate in peak hours, this plant needs to sell around 800 megawatt hours for each peak hour during the month of May. Looking at the CME Group PJM Western Hub Real-Time Peak Calendar Month 50 Megawatt Options Contract, ticker symbol PMA, and assuming 20 peak days in May, the plant would need the equivalent of 320 options contracts to equal the 800 megawatts per hour for all the peak hours in May. The most straightforward approach for this plant to manage its position is to sell their generation on the spot market while also going long a May PMA out of the money put, with a $21 strike price. Assuming the current May average forward price for PJM Western Hub is around $35 per megawatt hour, the out-of-the-money put option might only cost 30 cents per megawatt hour to execute. At the end of May, two scenarios could happen. In Scenario 1, the economist's forecast was correct and prices increased. The nuclear plant was able to sell its output in the spot market at an average price of $40 per megawatt hour. When you consider the cost of the option at 30 cents, their overall profit would be $40 minus 30 cents, which equals $39.70 per megawatt hour. In Scenario 2, we'll assume the economist was wrong and prices fell to $17 in the spot market. This is $3 less than their operating costs. For this scenario, the plant was only able to sell its output at $17 per megawatt hour. However, the financial position on the exchange will have a payout of $21 the strike price minus $17 the current futures price minus 30 cents from the cost of the put gives us a total of $3.70 per megawatt hour. When you add this to the total price from the spot market sale, the plant's final output cost would be $20.70 per megawatt hour, which is sufficient to fund its operations. The electricity market is a dynamic marketplace. There are many variables that can impact the price of delivering electricity. When it comes to managing risk electricity futures and options on futures, this is one way wholesale market participants can hedge their price risk.